It's been a little bit over a month and it's time for another Bank of Canada meeting where they discuss rate hikes this coming Wednesday. We've got some more new data since the last rate hike. The Bank of Canada has some new warnings for businesses, and we will be discussing all of this in this video coming right up. But before I go on, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. Let's do a quick refresher on where we left off with the Bank of Canada last time. At the last rate hike meeting, the Bank of Canada raised rates by 25 basis points, but they also gave a strong forward guidance telling us that they plan on pausing rates to monitor the lagging effects of rate hikes on our economy. They said they had a pretty good idea of where food prices, oil prices, and even shelter prices will go, but the trickiest part is to control services inflation because a lot of it does depend on our tight local labor market. And since then, we've seen a lot more data come out. We've seen housing starts that appear to be slowing down, which would be a big problem because our population is growing quickly, and that could translate to even higher shelter inflation. We did do a separate video on this topic specifically, but here's a quick summary right here. The news was based on just 1 month of data so far, comparing near peak housing starts in December of 2022 to seasonally low housing starts in January normally. So it's not a very good comparison, and we will have to continue monitoring this before we give a concrete view of where things are going. We also saw a labor market that was way stronger than expected. But once we dove into that, it did appear that it is correlated to the immigration growth that we have been seeing. And the good news is that wage growth isn't as worrying for now. And then we also saw consumer spending data come in stronger than expected, which does mean that our economy is a lot more resilient than we thought, but not good news for the Bank of Canada. We will need to see softer spending in order for inflation to come down. Finally, we do have inflation numbers coming in for the month of January, and this finally offered a glimpse of good news with inflation numbers coming in below expectations, which does give the Bank of Canada more confidence to pause interest rates for now. Both the headline and core CPI came in below expectations, and when you dig into the basket composition, you would see that food inflation makes up a good chunk of that high inflation number in January, which is the big problem. The other thing was that energy prices also came back up, and that was also not as expected because we were expecting it to come down a bit more. On the other hand, services inflation didn't see as much of an uptick, so that's the good news. Now, because food inflation came out stronger than expected, Tiff Macklem is not impressed and suspects that some businesses are taking advantage of high inflation to hike prices more than needed in order to pad their bottom line because commodity prices and supply chain improvements should point to price gains slowing down. So his big warning for businesses is that if they don't act more ethically, then the BOC might have no choice but to do something. Finally, Canada GDP came out and flatlined in Q4, which was way below market expectations, calling for a 1.5% increase and even below Bank of Canada's forecast at 1.3%. Ultimately, there's data to support more rate hikes and data to support a pause. But I think at the current moment, the strong forward guidance from January still remains intact. And if the BOC wants to remain credible with the rest of us, we don't anticipate that they will be raising rates this next round in March. At the current moment, all of the big banks are still predicting that the BOC will maintain target rates at 4.5% for the rest of this year, with the exception of Scotia adjusting upwards their forecast by 25 basis points because they thought rates would peak at 4.25%. The bond market is reacting a bit differently with bond yields creeping up again. So in other words, the bond market is pointing to a higher chance of more rate hikes from the BOC. So as you can see, we are now seeing more of a divergence overall, And it is hard to tell what might happen, but the BOC will probably be monitoring these things more closely in the future to make their decisions. Food inflation is coming in stronger than expected, and it could possibly be caused by businesses taking advantage of the situation. So BOC will be looking at both headline inflation, which takes into account food and energy, plus core inflation, which excludes food and energy instead of primarily looking at core inflation like they mentioned before. 2, the BOC should also be continuing to monitor services inflation because to them, that's the trickiest thing to predict. And 3, finally, the rate of increase would also be important to look at because the Bank of Canada doesn't want to see inflation go over 3% annually, which would mean a 0.25% increase month over month on average. We just saw a 0.5% month over month increase, and so future steps do need to look smaller if we want to see our target rates remain at current levels for the rest of this year. We're a real estate sales brokerage, and the reason why we're monitoring all of this economic data very closely is because the housing market is highly dependent on interest rates. When interest rates rise, we tend to see home prices fall and rents go up. And most of these effects have actually already been priced into the Toronto real estate freehold market, seeing at least a 25% drop from the peak. And that's why we're now seeing more demand because the price is now right as long as interest rate expectations don't change much more beyond this point. However, any future rate increases not yet priced in can translate to more price drops and more rent increases. And this case is definitely still possible, and so we will continue to update you on any news on this front. And because this is our expertise and really our passion as well, if you do want to invest in Toronto real estate and you want to discuss a more personalized real estate investing strategy with us, we would be happy to chat. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching and see you in the next video.